What if your mortgage is secretly a trap? Right now, rates are still low, but that won't last. Imagine you bought a home in 2020 with a 2.9% loan. That feels cheap. But what happens in 2026 when rates spike to 6% or higher? Suddenly, your monthly payment skyrockets. Selling your home becomes brutally hard because buyers can't afford your old rate. They want what you have, but at today's prices, your home looks expensive. This is the real estate lock-in. You own a house, but can't sell without losing money. Think about your situation. You might owe $300,000. You're pulling $100,000 a year from your investments. Paying off that mortgage at 2.9% sounds smart. But do you? If rates jump next year, your fixed-rate loan becomes a gold mine. Yet, if you sell, the market demands a higher price. You might only get $350,000 instead of $400,000. The difference is gone. This isn't just theory. It's happening. Investors watch the front end of the yield curve closely. Why? Because they expect the Fed to act soon. When rates rise, home prices stall. Sellers get squeezed. Buyers freeze. You're stuck in a market that refuses to move. Ask yourself, can you sell your home in 2 years? Will buyers pay your asking price? Or will you lose thousands just to walk away? The lock-in effect is real. It hits hard when rates climb. You might own $1 million home, but if you can't sell, you're not really free. The money you need could be tied up in a house that won't budge. So, should you pay off your mortgage at 70? Maybe, but timing matters. If rates stay low, keep your loan. If they rise, sell fast, or pay it down before it hurts. The goal is flexibility. Don't let your home become your anchor. Think of your mortgage rate as a ticking clock. It's not just a number on a statement. It's a moving target waiting for the next shift in the Fed's policy. We're seeing whispers that rates could jump soon. Imagine you save $200 a month for 5 years. That's $12,000 sitting there. Now, if the Fed raises rates next quarter, what happens? Your fixed loan might look cheap, but the market outside your door gets pricier. You're locked into a low rate, but the cost to refinance or sell rises. That's the window. It's narrow. Consider this. If inflation ticks up, the Fed responds. Rates climb. Suddenly, your 2.9% loan looks like a steal, but only until it doesn't. Say you owe $20,000 at 2.9%. Paying that off now saves money. But wait, what if your home value drops 10%? Suddenly, that debt-free win feels smaller. You've paid off debt, but your net worth shrinks. Flexibility is key. Don't let your house become your anchor. If rates jump, sell fast, or pay it down before it hurts. The goal is flexibility. Don't let your home become your anchor. Think about the front end of the yield curve. Investors watch it closely. Why? Because it signals where rates are headed. If the curve steepens, your mortgage rate isn't the only thing moving. Your life plan is. Are you ready for a rate shift? What if inflation hits 3% next month? Your buying power drops. Your mortgage payment stays the same, but everything else costs more. That's the real cost. You're trading a small, fixed cost for a volatile, rising one. Smart money moves before the storm. Imagine you owe $300,000 on your home. Right now, your mortgage sits at 3%. That 3% is free money the bank is paying you to keep their loan active. You get that interest tax-free. It flows straight into your pocket every month. Now, picture the rate climbing to 7% or higher. What happens then? Your fixed cost suddenly explodes. That same $300,000 debt now costs nearly double. You are swapping a cheap, stable bill for a heavy, volatile one. Think of it like this. You are currently earning a 3% return on cash you hold in your home. If you pay it off, you lose that return. But if rates hit 7%, your existing loan becomes a hidden windfall. You are effectively earning 4% more than the new market rate just by staying put. That 4% is pure profit. It's the gap between what you owe and what new loans would cost. Over a decade, that gap compounds. A simple math example shows the power. If you pay off your loan now, you stop paying that 3% interest. But if you wait until rates rise, you keep paying the old rate. The difference between 3% and 7% is a massive 4% annual advantage. Over time, that advantage adds up to tens of thousands of dollars. It's like finding a 4% savings account that never closes. Smart investors watch these gaps closely. They know that locking in low rates before a storm creates real wealth. The money you save isn't small change. It's the difference between a secure foundation and a crumbling one. What if your mortgage rate is 3%? That sounds low, but what happens when you try to pay it off at age 70? Think about the real cost. You aren't just paying interest on a loan. You are paying for the transaction itself. Closing fees, agent commissions, title insurance. These add up fast. A typical sale might cost you 6 to 7% of the home's price. That's a huge sum. Now, imagine you owe $300,000 at 3%. Your annual interest is roughly $9,000. If you pull $100,000 from your investments to pay it off, you lose that principal. But you also stop paying that $9,000. So, you save $9,000 a year. But when do you break even? You need to recover those 6 to 7% in costs. If your home is worth $500,000, that transaction costs $30,000. Dividing $30,000 by your $9,000 annual savings gives you just over 3 years. But what if your home is only worth $300,000? The cost drops to maybe $18,000. Your savings stay at $9,000. Break even takes 2 years. Still fast, but not instant. The key question is, how long will you stay in this home? If you plan to live there for another 15 years, paying off the mortgage makes sense. You've recovered costs and built equity. If you think you'll move in 5 years, the transaction fees eat up your gains. You'd be worse off. Also, consider what you do with that cash. If your investments earn 6%, pulling out $100,000 means you miss out on $6,000 a year. That offsets your mortgage savings. The math shifts. Your break-even point moves further out. Don't just look at the interest rate. Look at the full picture. Transaction costs, investment returns, and how long you stay. Only then do you know if paying off that mortgage at 70 is a smart move. It's not about the rate alone. It's about the timeline and the total cost. Think about what happens the moment you try to sell a home in 2026. The market isn't just slowing, it's tightening. Imagine you list your house for $400,000. You might find only 3 buyers in your neighborhood. That's a drop from the usual 10 or 12. Why? Because inventory is low. Cash buyers are snapping up properties quickly. They don't need mortgage approvals. They close in days, not months. Your traditional buyer might need 45 days to secure a loan. What if their rates spike right before closing? That deal could vanish overnight. Consider the risk of a rate shock. Say your current mortgage rate is 6.5%. A buyer securing a loan at 7.5% might hesitate. Their monthly payment jumps by $100. Suddenly, their budget feels stretched. They pull back. Your sale stalls. Or worse, they walk away at the last minute. This isn't hypothetical. It's happening now. Lower inventory means higher competition among sellers. Buyers wait. They shop around. They demand concessions. Your equity gets eaten by repair credits. You end up with less cash in hand than expected. Now ask yourself this. Does selling at 70 make sense if your home won't sell cleanly? Selling isn't just about price. It's about timing and certainty. If you owe $300,000 and sell for $380,000, you net $80,000. But if the deal falls through, you lose the $5,000 in agent commissions. And that's before accounting for moving costs. What if you need that money to cover healthcare? A failed sale disrupts your plans. It forces you to delay retirement goals. The real hurdle isn't just the rate. It's the liquidity. Can you sell fast? Can you sell at a fair price? If the answer is maybe, paying off your mortgage might be safer. Keep your home. Stay put. Let the market decide when you're ready to move. Don't force a sale into a tight window. Protect your cash flow. Secure your future. What about the middle ground? You don't have to choose between holding on forever or dumping everything today. Consider a rate buy-down. This lets you lower your current interest cost without paying a massive prepayment penalty. Imagine you owe $200,000 at 7.5%. You refinance just the first $50,000 at a lower rate. The rest stays put. Your monthly payment drops. Your cash flow improves. No need to sell right now. Or look at a HELOC. You keep your original mortgage intact. You tap a home equity line of credit to pay down the principal. Say you have a $300,000 loan. You pull $60,000 from your HELOC. You pay off $60,000 of your high-rate debt. Your overall interest burden shrinks. Your monthly payment shrinks. You still own your home. You still live here. These moves give you flexibility. You test the waters without committing. If the market turns, you're ready. If rates drop further, you can adjust again. Don't force a sale into a tight window. Protect your cash flow. Secure your future. Ask yourself, do you need to act now? Or can you wait a bit? If you're comfortable with a partial payoff, go for it. It reduces risk. It builds a buffer. It gives you breathing room. Remember, the goal isn't perfection. It's progress. Small steps often beat big leaps. You control the pace. You manage the risk. You stay in charge of your finances. What if you stopped viewing that mortgage balance as a locked sink for your cash? Instead of paying off that debt, consider redirecting your monthly payment toward diversified assets or building a robust emergency fund. Imagine you're putting $400 a month into a mix of stocks and bonds. Over a decade, those contributions could grow into a substantial nest egg, especially if the market delivers returns that exceed your borrowing cost. Even at a 3% interest rate, your money might outperform that by investing in assets with an average annual return of 7% or higher. That's the power of compounding working for you instead of against you. Think about how much flexibility an emergency fund gives you. With $6,000 in savings, you could cover 6 months of living expenses without touching your investments during a downer. That security lets you hold steady when markets wobble, avoiding forced sales at the worst possible time. It's a buffer that protects your long-term plan. Consider the opportunity cost. Every dollar tied up in a low-interest mortgage is a dollar not working in the market. If your investments earn 6% annually, your monthly payment is effectively generating more value than the interest you'd save by paying off a 3% loan. Over time, the cumulative benefit of investing outweighs the marginal gain of eliminating that debt. You're not just reducing a balance, you're building wealth. Ask yourself, where does your money work harder? In a savings account earning near zero, or in the stock market with the potential for growth? The answer shapes your future. You control the direction. You decide where your resources flow. Keep moving forward with purpose. So how do you decide if the time is right? Start by looking at your home equity. If you owe less than you own, you have a cushion. That cushion matters. Next, ask about your age. Are you still building wealth, or are you drawing it down? A retired couple with $2 million in savings might consider paying off a 2.9% mortgage to reduce monthly spending. But a 70-year-old buying a $1 million home in cash could run out of money by 90. The break-even point shifts with your timeline. Then, check your career stability. Do you have a steady income stream, or are you relying on investments alone? Volatile markets demand lower risk. Think of your personal risk tolerance. Would a sudden drop in your portfolio scare you? If yes, locking in a fixed cost might feel safer. Finally, consider your cash flow. Are you withdrawing $100,000 a year from investments? That's a huge outflow. Reducing it helps. Imagine you owe $20,000 at 22%. That's a massive burden. Paying it off frees up cash. Now, imagine you owe $300,000 at 2.9%. The impact is smaller, but still real. Ask yourself, does this debt limit my freedom? If the answer is yes, action makes sense. If no, maybe not. Keep your eyes on the big picture. Your future depends on the choices you make today. What path feels right for you? Do you want security, or do you seek growth? The answer shapes your next steps. You control the direction. You decide where your resources flow. Keep moving forward with purpose. Think of your mortgage as a ticking clock. Every month, your lender eats into your retirement savings. Imagine you owe $300,000 at a low 2.9%. You're pulling $100,000 a year from your investments just to live. Does paying off that loan make sense? Maybe, but only if the numbers align. Consider this. If you buy a house for $1 million in cash at age 70, will you run out of money by 90? The break-even point could be decades away. You might spend years just to recoup the principal. That's a long time to wait for a return. Now, imagine rates rise. Suddenly, your fixed cost stays the same while your home value climbs. Is your lock-in still working? Or has the tide turned against you? The answer depends on your timeline. If you plan to stay put, a low rate is a gift. If you need liquidity, a high rate is a burden. So how do you decide? Get a current rate quote today. Calculate your break-even point with precision. Decide whether to lock in a sale or prepare for a future rate reset. Don't leave it to chance. Your money deserves a plan. Your future self will thank you. Keep moving forward with purpose.